Alright guys, so this video is going to be about investment strategy. I will try to keep it light and short as we did for previous videos, and therefore this will be more digestible for you instead of me putting a 35-minute video that will take all your breakfast and part of your lunch. I will try to put maybe 5 to 10 minutes videos on 4 different categories, and this way you can manage them in terms of watching them a little bit more digestible format. So in terms of investment strategy, it is explained on my public profile as a pinned post, and also in my bio that's on the right hand side when you look at my profile on eToro. It is a relatively complicated strategy. In simple words, it's close to Black Litterman model. This is a model that was invented by the 2 gentlemen in 1992 at Goldman Sachs. They were looking at a little bit MTP kind of model, so model portfolio theory, which talks about diversification and having maybe between, I think it's 20 to 50 assets in your portfolio, and then have uncorrelated returns, and then trying to maximize the gain thanks to diversification. So that's what we are doing in an improved way. And so you will almost always see about that amount of instruments in the portfolio. At the moment, I think we're at 47 instruments. I like to move between 23 and 45. I found it to be the best. In fact, if we have 23, then we have a little bit more of a grip on the portfolio, because then I know the companies very well. You've seen me investing in Aston Martin this year extensively, in Peloton, and if we have companies like this, it's actually very easy for me to manage because I'm very close to those companies, and it's easier to obviously keep abreast of 23 companies than 46, right? So it's obviously very, very different. Also, I am a value investor. I don't necessarily need a value investor badge because I prefer to stay independent and do the decision based on my models rather than stick to a very, very specific strategy that maybe is called value investing. It's probably 80% of the portfolio is actually value investing compliant fully, as I like stocks that are undervalued and that will grow over time. You would see me investing in companies such as Aston Martin, largely undervalued. Peloton is obviously a little bit more of a growth stock, but the most money has been made really on the United Kingdom this year. So a company like Micro Focus ballooning to about 120%, National Express another 120% or 140%, AMS in Zurich growing over 100%. Even Porsche was bought as a value stock at that time. So this is a big part of the portfolio. So I would say it's a mix between kind of value investing and MCP, with improved models that I learned in finance already in the last 17 years. And actually I put my own decision making after that, as I have access to some world's best tools. It's not difficult to find what are the best tools in finance. I will not talk about that, but I have spent 6 years at Thomson Reuters using those tools every day, and kind of, not being able to act on any of the information I was getting firsthand, because obviously we need to wait until it's public information. So then you can do trade, otherwise it's illegal. So I think the easy way to talk about strategy is I always look at risk-adjusted return. I did put a video explaining what's the difference between a total return portfolio, risk-adjusted return, and capital preservation. These are 3 categories that are classified by Leaper, which is a leader in the fund industry. They are basically having a slightly bigger market share, I believe, than Morningstar. Many of you more know Morningstar. Leaper is a little bit more advanced. Morningstar has been used more for marketing professionals and product management people, so they have 5 stars for a fund, and it's very, very easy to understand. Leaper is much more for advanced people, so maybe portfolio management rather than product management, and really asset managers. They have these huge Excel files, and then they do the rebalancing of their portfolio based on the metrics that they have. They have very complicated risk mechanism. Standard deviation that we use here in eToro is just one metric, one of probably about 25 that they would use. Sharpe ratio is one that I've seen that's used much more widely than standard deviation in measuring risk. But this video is not about the risk management or how we are using it, but it is about the strategy. So the strategy, I think we sit comfortably about risk 4 or 5 in the portfolio maximum. Actually, the last 3 months we have not been exceeding 4 at all, and one of my investors has 100% invested in me and 8% cash, and they sit at risk 3. So that tells me that if we just had 8% cash more, we would be at risk 3. So we're about 6 minutes. I will continue probably till about 10 because there's just so many things in the strategy. So I think you should think about it as a risk-adjusted return. This year we have, we've made 100% since March on a $10,000 invested, because we went at 10, went to 7 with Porsche, and then went to about 14. So that's 100%. So that's one of the last posts that I've made. You only see about 40% at that time. And obviously when we move to March 2021 and we go on the trailing 12 months, this will look very, very beautiful, and we'll get much closer to 100%. So we'll get there. It's just about understanding how performance is measured and calculated and using different metrics. Finance is not as easy as you may think. It's not just about buying Tesla at 350 and never selling it. Believe me, it is much more important and more complicated, and I think in 2021 you will see those risk-adjusted return largely outperforming total return, and I think those total return folks will actually, like we say in finance, lose their shirts. So this is a shirt, and that's how we say it in finance. I will not comment anymore and ever. So if I do, please tell me that I should not about any other investors. I have spoken to eToro management extensively these days. They work very hard on Sundays, so I've tried to communicate with them on that days, and I have been advised to focus on our portfolio. We are almost 400 investors at the moment, and we are managing about $1 million of asset under management in US dollars. I have been asked how I feel about it. Well, I feel these are rookie numbers. I did put 30 million of asset under management as a goal. I would like to get there till March. It's an ambitious goal. I should be able to raise myself about $2 million very, very quickly and grow from there. And I actually want to revise this to 50 million as quick as we possibly can. And I think only then will be even more interesting. And our risk-adjusted return will obviously playing to a lot of those people who put maybe 20,000, maybe 50,000, maybe 100,000, maybe 1.6 million, as one of you declared to be interested in putting. And so this is, a little bit more important for you to also preserve the capital. I'm not about capital preservation. There are a few investors here that just focus on having a green month. All good and fine. I think it's a good strategy in times where there is no inflation and there are no opportunities on the market. So you actually think the market's going to go down, and then being green is absolutely phenomenal. But what we've seen since March, for me, it's an opportunity in a lifetime. Waited 11 years for this to happen, almost 12 actually. And so I'm very, very happy that we've generated so much return. We'll be about, I think, 70-80% on a rolling basis when March comes. And then obviously we will top most of the charts, and then the growth will come. I'm not a patient person by nature, so I would obviously like to see 30 million as soon as possible, but I know we are getting there. Our asset management and copiers are increasing steadily. We nearly tripled in the last month and a half since I've been able to focus fully on the portfolio. So think about it as a risk-adjusted return with a goal of generating about 20% a year. These are the returns of the best educated people in the world. So if someone tells me they have a higher goal, I will be skeptical, and I will not buy Tesla, and I will not buy Bitcoin to get there, because that's not what I believe in. So you're free to do that, but please do not expect that from our portfolio. Thank you very much.